Hi everyone, I'm Zach with the Money Channel, and I think it's best that we dive into it. As an overview, so there's been some chatter around the investments in SPY, VOO, and SCHD recently. I thought it was interesting, so I thought we'd have a look at it. Very quickly, everything you hear in this video is not views held by the Money Channel. There is no financial advice in this video, but I wanted to collate all the opinions around SPY, VOO, and SCHD into this video. And with that said, let's look at the question, why are people so into SPY when VOO has a third of the fee? I see so many people invested in SPY and talking about it, but VOO has 1/3 of the expense ratio, 0.03 versus 0.09, and more assets under management. My question is, why is SPY so popular when VOO seems to be an outright better S&P 500 ETF? I know they have the same holdings of course, but it just seems like there would be almost no reason to hold SPY when you could hold VOO instead. Is there something in the options market that I'm not seeing? I don't really do options, so this is all I could think of. Sorry for rambling, but it's a really short question and I don't want to get it taken down. Anyway, SPY versus VOO, why are people into SPY when VOO is a better option? I trade SPY options and long-term invest with VOO. This is the right answer right here, SPY for options, VOO for long-term buy and hold. What about SPX for options? I see they get mentioned often. European versus American options, and also SPY has a tighter bid-ask spread. SPX also has a better tax treatment, 60% tax long-term, 40% short-term, but also requires 10 times the buying power. So why buy SPY? You should have a fairly large account for SPX. A 1 DTE in a typical IV environment is around $2,000 to $2,500. Getting reasonable theta often makes the contract run into the 5 figures. So if you are only risking 1 or 2% on a day trade, you need a 6-figure account. There is a tax-preferred contract that is priced like SPY, 100 shares per contract, versus SPX is 1,000, but it is illiquid compared to SPY, so not very good for trading. Also, SPX's delta and gamma increase per point of price action, so you can see $750 evaporate 12 seconds after you buy a contract, and you need the emotional control and account that can weather this. That being said, it's possible to buy a deep OTM contract on SPX for $100, and if it's a crazy 2 to 3% trend day, turn it into like 5k, Lord knows how many accounts have been blown chasing this. Can someone point to a good guide or explanation for why and how to get into options for an ordinary trader and not a day trader? You don't. SPY's options are more liquid. The ticker is cooler too. I think VOO is one of the cooler tickers. Roman number V with OO equals 500 S&P 500. Oh my gosh, how did I not realize that? Because I think he made it up. It's more liquid in general. SPY average daily trading volume is 90.6 million shares while VOO is 4.1 million. SPY options are more liquid and with daily expiries compared to VOO's once monthly expiries. VOO is better if you're just long-term investing. For anything else, SPY is the winner. I keep 100 shares of SPY for wheeling options, but the remainder of my long-term account is VTI. The ticket is cooler, so it's about options liquidity. How do they compare in that sense? SPY has the best option chain, daily expirations. VOO has low volume, wide spreads, and monthly expirations. Lots of people have had SPY for a long time, and normally it would be a bad idea to cause a tax event to switch. You save about $600 in fees for a year if you have $1 million worth of shares, but with SPY you sell 20 cover calls just one time and you already beat their fees. If you sell cover calls all year, that could be a retirement income, hypothetical scenario of course. If you're going for a low expense ratio, go with Fidelity's index fund FXAIX. The ratio is 0.015. Fidelity has 4 funds with 0 expense fees. The downside is there are mutual funds, so there's more taxes than ETFs because of capital gains distributions. If you're 100% certain you'll be with Fidelity for life, go with these options. If there's even an ounce of doubt, spring for the Vanguard option. Why do you say that? Is there a catch with Fidelity funds? The ones with 0 expense ratio can be only held at Fidelity. If you want to move to a different brokerage later, you will have to sell them and incur taxes in the process if you have gains. Sell covered calls on my holdings, basically get a monthly dividend. How long have you been doing that for, out of curiosity? Asking because I'm curious about covered calls and puts. It is a good way of making some income on your investment, but there is always risk. I'd recommend some YouTube videos lots out there. You basically sell a contract to buy sell shares at a given price over a given time period and collect a premium. It's been around longer, and SPY is synonymous with SP 500 ETF. The fee differences are nominal, so those which have SPY likely just stick with it. Everyone knows VOO is better than SPY these days, but it's such a trivial amount that it's not a big deal. SPY looks like 0.09%, but is actually 0.0945%. They chose that expense ratio so it looks better when rounded down. Shady in my opinion. Yeah, that extra 45 cents per $10,000 invested is really shady. VTI is even better. Vanguard ETFs are better, full stop. top, so VOO over SPY. But VOO's derivatives are crappy while SPY's are literally the best. I agree, that's why I'm wondering why people are big into SPY. Because there's no practical difference between a 0.09% ratio and a 0.03% ratio. We're literally talking less than pennies for your average person. If you put all your money into SPY and have a 100k portfolio, then you lose $60 per year. Sure, if you only have $1,000, then it's just pennies, but I doubt this is average. Many have SPY as their one and only investment, then it adds up, so much so that SPY takes hundreds of millions more in fees than VOO would be for the same size. SPY is for degenerate gambling on zero date to expiry options, VOO is for longing the US market. That's how I use it, derivative platform versus responsible money. There is also IVV from BlackRock, same expense ratio and liquidity as VOO. You will know the answer when you try to sell VOO. Liquidity dries up and you find yourself selling at a lower price than the underlying. SPY is at 400, but when you try to sell VOO at 400, no takers, but plenty at 395. Why not go VTI, 0.03 ratio, a dividend and total market instead of only 500? I do hold VTI, but that's not what I was wondering. I was going apples to apples. To sell options once they reach 100 plus shares, SPY is better, otherwise VOO or IVV for S&P 500 ETFs. Honorable mention, SPLG if your broker doesn't offer fractional shares for ETFs, Merrill Edge, Schwab, TDA, Ally Investing. There are a few emulation ETFs that even have cheaper expense ratio. One is completely free and seem to have better returns right now. The drawback is lower BA spread as volumes are lower. As an aside, for long-term buy and hold, in my humble opinion, mutual funds are the way to go. Expenses might be a tiny bit higher, but there's no slippage, price diverged from the underlying assets, and you get all the bells and whistles of partial shares and automatic investing. I use M1, which has automatic reinvestment and partial shares. SPY was the world's first ETF, it's got a neat history to it. That and SPY has a good name, easy to remember. VOO, what does that stand for? It doesn't exactly market itself, but regardless, VOO has been picking up volume over the years, and newer investors and traders have been defaulting to it. SPY has 0-day options every trading day, so if you care about that, then it's your only option. But VOO for non-Wall Street bets types has plenty of options volume, so it's fine. For years now, I've defaulted to saying VOO. When I'm talking about S&P on these subs, no one has asked me what I mean, so I imagine it's pretty standard knowledge at this point. It stands for 500, Roman numeral V and 2 O's. The 400 fund is IVOO, the 600 fund is VIOO, the Russell 1000 fund is V1, and the 2000 fund is V2. Why not FXAIX? 0.015 expense ratio. It's not an ETF, I was just comparing the two. Personally, I hold ETFs because my preferred brokerage doesn't have mutual funds, just ETFs. Then we have someone asking, at what point should I stop buying SCHD and start getting VOO? I've read lots of posts and it seems people generally like SCHD and VOO. I'm 30 and my fiance and I started stocking up recently. I keep buying SCHD and when I want to get to VOO, I just end up buying more SCHD. Simple, just use your salary to invest in SCHD. And then use the SCHD dividends to buy into VOO. I wish there was an easier way to set up drips like this on most sites. While drip being automated can be very handy, but being able to reinvest the dividends yourself does have some benefits. It puts you more into control as to when to reinvest and also if maybe to decide to reinvest into a different stock. Nothing like drip being used to buy fractional shares you can't sell. On Fidelity and likely all the other major brokerages, you can sell fractional shares. The only restriction at Fidelity is when the transaction would be less than $1 or set a limit price good for more than the current day. Perhaps you should just set up a recurring investment for both. For example, let's say you are tossing $50 a week into the account. Maybe you should do $3 daily recurring investment of SCHD and $2 per day into VOO. Personally, I do something like that with drip turned off on practically all of my positions. Instead, I have daily investments that are a bit below my dividend payments that are coming in each month. Over time, my portfolio will shift towards the positions I am buying into without selling off the other positions. Over time, my buying power increases and from time to time, I go looking for additional deals to either buy into or positions that I want to add to my recurring investments. To be clear, I have a lot of monthly dividends and I have to manually deal with quarterly dividends that aren't on drip, but that isn't an issue since I look at my account daily. This sounds like a solid strategy of splitting. I have drip on right now since manually managing that seems like a lot of work. I do SCHD and VTI. I looked at VTI and VOO a lot today and everything seems similar even with the lower caps included. I like VTI over VOO because it has a bit more volatility to it. This makes it so I can get in on some of them lower lows to buy in on and get more increases on those lows when the lower cap stocks take off. VOO has slightly more total return compared to SCHD over the course of the last 10 years. While you can't assume this trend will continue continue? If you did, you'd want to start buying VOO now since you need growth given your timeline until retirement. Yeah, they seem pretty close to one another. I've been investing every week in a target date index fund for retirement about 8 years now. So you have a separate investment in target date fund, and additionally you put money into SCHD. This is correct. A portion of my paycheck gets automated into the 401k with the target date index fund. This is more trying to be responsible with the money I have left after that. I'm really good at spending money on things I don't need if I have money laying around.